When most people decide to get into crypto, their first instinct is to buy Bitcoin or Ethereum outright. But that's only scratching the surface. There are other ways to gain exposure, some easier, some riskier, and some that might even surprise you. Each comes with its own mix of costs, control, and opportunities, and the right choice can mean the difference between a solid long-term position and an expensive mistake. My name is Danilo, and today we're going to unpack the main ways investors are getting into crypto so you can figure out which one fits your portfolio and your goals. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright? Let's get into it. When you think about owning crypto, it's easy to assume there's really only one single way. Buy some Bitcoin or Ethereum and just call it a day. But the reality is, there are multiple wrappers for the same underlying asset, each with its own rules, risks, and benefits. Broadly, you can split them into three lanes. The first is buying the native cryptocurrency itself, where you actually hold the coins, either in your own wallet or with a custodian. The second is a spot crypto ETF, a regulated investment fund that holds the asset for you and trades like a stock. The third is owning shares of a public company whose business and balance sheet are heavily tied to crypto, like MicroStrategy or certain mining firms. All three give you exposure to the same asset, but the experience of owning them is very different. The market structure, the type of risk you're taking on, even what you can do with your investment, these can change a lot depending on which lane you choose. And that's why understanding these differences can save you from costly mistakes and help you find the right fit for your own style of investing. Owning the native cryptocurrency like Bitcoin or Ethereum means you hold the actual digital asset itself and not a paper claim or a stock tied to it. You can keep it in your own wallet, which gives you complete control, or you can leave it in a custodial account on an exchange. Self-custody means you're the only one with the private keys, which is the digital version of having the only key to a vault. If you lose it though, it's gone. Custodial accounts are easier but requires trusting the platform, and history has shown that trust can be risky. Getting exposure starts with buying through a centralized exchange like Coinbase, Binance, or Kraken, which lets you deposit fiat currency and swap it for crypto. More advanced users might use a decentralized exchange or DEX, such as Uniswap or Jupiter, where you connect your own wallet and trade directly on the chain. Once purchased, you can decide on storage, a hot wallet for quick access, a hardware wallet for long-term safety, or leaving it on the exchange, which is fast but carries counterparty risk. You'll pay network fees for on-chain transfers and trading fees that typically range from 0.01% all the way up to 1%, depending on the platform. On Ethereum, gas fees can spike significantly during high activity, while Bitcoin fees are generally lower but can still surge during congestion. The biggest advantage is full ownership. You can send your crypto anywhere, trade it anytime, and in some cases put it to work through staking or lending. With Ethereum, for example, running a validator or using a liquid staking token like STETH lets you earn yield while keeping your asset liquid for DeFi opportunities. That's something you simply can't do if your exposure is through an ETF or a stock. Liquidity is also instant. You can move value globally in minutes without banking hours. But with that control comes a steep learning curve. Mistyping an address or falling for a phishing scam can mean permanent loss. The market never sleeps, so you're exposed to volatility 24/7, and unlike ETFs, there's no pause button when things get rough. During periods of extreme price swings, even major exchanges can go down or slow withdrawals, leaving you stuck. Your portfolio value can move double-digit percentages in a single day, for better or worse. A clear example of why custody matters happened in November 2022 with the collapse of FTX. Customers who kept assets on the platform faced months or years of uncertainty over whether they'd ever get them back. Meanwhile, those who self-custodied their assets weren't affected beyond normal market volatility. This single event shifted many investors towards managing their own wallets, with hardware wallet sales spiking in the weeks after. So, native crypto ownership is the most direct, flexible way to hold these assets, but it's also the one where you're taking full responsibility for security and decision making. For some, that's empowering. For others, it's a deal breaker. A spot crypto ETF is a regulated investment fund that directly holds the underlying cryptocurrency, typically Bitcoin or Ethereum, in cold storage with a custodian. When you buy shares of the ETF, you're effectively buying a fractional interest in that pool of crypto, tracked through the fund's net asset value or NAV. Shares are created or redeemed through authorized participants to keep the price in line with the actual market value of the assets. This in-kind creation and redemption mechanism helps reduce big premiums or discounts, though, in volatile markets, short-term gaps can still happen, especially during sudden weekend moves. Getting exposure is as simple as buying any other stock or ETF. You can log into your brokerage account, whether that's Questrade, Fidelity, or even a mobile app like Wealthsimple. Search for the ETF ticker and trade during normal market hours. This also means you can hold it inside registered accounts like an RRSP or TFSA in Canada, or an IRA or 401k in the US, which can be a major tax advantage. The catch? The ETF trades on a stock exchange schedule, while the underlying crypto trades 24/7. If Bitcoin crashes on a Saturday night, you can't react until markets open Monday morning, and by then, the damage may be worse. Likewise, a sudden rally can leave you watching gains happen in real time without the ability to act. These weekend price caps can work for or against you, making timing risk an unavoidable part of the structure. The biggest benefit here is the simplicity. There's no seed phrase to remember, no wallet to set up, and no learning curve around blockchain transactions. It's a familiar, regulated wrapper that also fits neatly into a diversified portfolio. Expense ratios on spot Bitcoin and ETH ETFs have been trending lower. Many now fall between 0.2 and 0.4% annually, but those fees still chip away at returns over time. Over multi-year holding periods, even these seemingly small percentages can meaningfully drag on performance compared to direct ownership, since the fee is taken every year regardless of whether prices rise or fall. For large positions or long holding periods, that ongoing cost can be meaningful compared to self-custody, where the only fees you face are network and trading fees when buying or moving the asset. And unlike holding the actual asset, you can't use your ETF shares for staking, collateral in DeFi, or payments. You're simply holding a price tracking instrument. One of the most common surprises for new ETF investors is how market hours can create big opening gaps. Imagine Bitcoin surging 8% on a Sunday after a major adoption announcement. ETF holders won't see that reflected in their account until the market opens, and by then, the price may have already retraced. This can also work the other way. A weekend crash might be partially recovered before ETFs trade again, softening the visible impact for holders. For many investors, spot ETFs offer the cleanest and lowest friction way to add crypto exposure, especially inside tax-advantaged accounts. But the trade-off is giving up both on-chain utility and 24/7 liquidity in exchange for convenience, regulatory oversight, and integration with traditional investment platforms. The third way to gain crypto exposure is by buying shares of public companies whose business models and balance sheets are heavily tied to Bitcoin, Ethereum, or both. These are still equities, so when you buy in, you're purchasing ownership in the company, not the underlying coins directly. The crypto exposure comes from assets they hold on their balance sheet or from revenue tied to crypto-related operations. This means the value of your investment is influenced by both the company's stock performance and the price movement of the crypto they hold. That dual exposure can create amplified moves in both directions. For example, if Bitcoin rises 20%, a company like MicroStrategy might rally 40 to 50% depending on leverage and market sentiment, while the reverse can happen just as fast in a market downturn. Getting exposure is as simple as trading any other stock. You can log into a brokerage account, whether it's Questrade, Fidelity, or an app like Robinhood or Wealthsimple. Search for the ticker and place an order during normal market hours. These shares can also be held in registered accounts like the RRSPs, TFSAs, IRAs, or 401ks, depending on your jurisdiction. There's no need for wallets, seed phrases, or managing private keys. This is entirely within the familiar stock market infrastructure. Just remember that, like ETFs, you can't trade them outside of market hours, and overnight or weekend crypto moves will only be reflected at the next open. One major advantage is leverage. These companies can sometimes amplify crypto gains through strategic buying, operational expansion, or financing. They can also generate revenue beyond their crypto holdings, adding another potential upside layer. For example, a mining company can benefit from rising crypto prices and increase production capacity at the same time, creating a double tailwind. Stocks are also highly liquid during trading hours and easily integrated into traditional portfolios. But The trade-off is company-specific risk layered on top of the crypto risk. Poor management decisions, heavy debt loads, regulatory crackdowns, or shareholder dilution can hurt the stock even if the underlying crypto is performing well. Broader stock market sentiment can also drag these equities down. A tech sell-off or recession fears could hit share prices even during a strong crypto market. MicroStrategy is the best known Bitcoin treasury play, holding over 600,000 Bitcoin as of today. Their aggressive buying strategy, funded through various investment vehicles, has made their stock a leveraged bet on Bitcoin, with share price swings that can even be more extreme than Bitcoin itself. On the Ethereum side, BitMine Immersion has rapidly emerged as the leading corporate ETH holder, shifting its focus from mining operations to large-scale accumulation. Since launching its ETH acquisition strategy in mid-2025, the company has built a treasury exceeding 1.1 million ETH, worth over 5 billion, and has publicly stated its goal of acquiring as much as 5% of the entire Ethereum supply. That plan is being fueled by major capital raises, with filings indicating it could secure 20 billion or more to continue buying. While its stock moves with Ethereum's price, it's also influenced by investor sentiment towards its aggressive treasury strategy and its ability to execute on such an ambitious target. Both examples show how crypto-focused equities can either dramatically outperform or significantly lag the coins they're tied to, depending on execution, cost management, and broader market conditions. For investors comfortable with stock market mechanics but looking for that amplified crypto upside, these plays can offer an intriguing middle ground, but one that requires watching more than just the price of Bitcoin or Ethereum. When you put these three options side by side, the differences start to stand out. Buying the native cryptocurrency directly means going through a crypto exchange or decentralized exchange, setting up a wallet, and deciding whether to self-custody or leave your coins with a custodian. It takes a little more effort, but it's the only way to have true control and actually use your assets on chain. Whether that's staking, trading in DeFi, or sending payments anytime, day or night. Spot crypto ETFs, on the other hand, are as simple as buying a stock. You can pick them up through a regular brokerage account, even in retirement accounts. They trade during market hours only, and while they track the price closely, you're paying a small annual fee for the convenience. You also give up the ability to use the asset on the chain. This is strictly about price exposure. Treasury-heavy companies are also bought through a brokerage, but here you're buying shares in a business that holds a large amount of crypto or earns revenue tied to it. That means you're getting indirect exposure, often with added leverage. If that asset rallies, these companies can move even more, but the reverse is also true on the downside. You also take on company-specific risks like debt, dilution, or poor management decisions. For different types of investors, the best fit may vary. If you're an active crypto user who wants to earn yield and stay plugged into the ecosystem, direct ownership is really hard to beat. If you're a traditional investor who values simplicity and wants crypto exposure in a tax-advantaged account, a spot ETF is the easiest route. And if you're comfortable with more risk in exchange for potentially amplified returns, treasury-heavy companies can give you that high beta play. Just be ready for sharper swings both ways. There's really no one-size-fits-all way to get crypto exposure. Direct ownership gives you control and on-chain utility, but also puts security squarely on your shoulders. ETFs make it easy and regulated, but you give up utility and pay fees. Treasury-heavy companies can supercharge gains if prices run, but bring their own business risks. It all comes down to your goals, your risk tolerance, and how involved you want to be in managing your own investments. Some people want to stake, use DeFi, and move assets around freely. Others just want to clean, regulated exposure in their brokerage accounts. So, which lane are you in right now, and why? Drop a comment below. I read all of them. And if you want more non-hype breakdowns like this to help you navigate the crypto space, make sure you're subscribed and have the bell turned on. Thanks for watching, and I'll see you in the next one.